Ladies and gentlemen, it is time for Crypto Q&A. And remember, if you want to get your question answered in next week's Crypto Q&A show where I answer your crypto questions, please leave them in the YouTube comments or tweet me at Hashoshi4. Again, this is a follow-up to Crypto Over Coffee every week where I answer your crypto questions. So the first question of the show is right here from Bitcoin or Bust from YouTube. Awesome content as always. Thank you very much. Do you think if all cryptos, including Ethereum, are classified as securities, that they could be delisted from exchanges and therefore become almost worthless? Many thanks. So let's just say that all crypto, how about this? Let's just say for the sake of argument that the Ripple Labs case with the SEC goes in the SEC's favor. Let's say there is a summary judgment and the SEC wins and says that XRP is a security. And that basically means that all ICOs are securities. That means all token offerings are securities for the most part. And that's probably how it's going to pan out. That's how people think it's going to pan out. I'm no lawyer. I'm no securities lawyer. Just bear that in mind. But let's just say for the sake of argument, all cryptocurrencies are defined as securities except for Bitcoin, which had no real token sale. Okay. If that's the case, what would likely happen is it wouldn't drive everything to zero, in my opinion. But what it would mean is that only certain highly regulated exchanges would exist. All these securities frameworks that exist today would have to be followed. That means that all cryptocurrency foundations, so foundations and open source projects, would have to register and file as if they were operating a company that issues securities. And so therefore, you would have very few exchanges and very few crypto projects that were, in fact, compliant. And we would get there, but it would really be a huge culling. You would have a lot of crypto projects that would completely go away. You would have a lot of exchanges that would not be able to comply, and they would go away. The fact of the matter is, I don't even think that the regulators are prepared for that type of thing to happen, because what would inevitably happen at that point is you would have this huge explosion of regulatory disaster. You would have filings, you would have confusion, you would have lawsuits, you would have all sorts of things just catching on fire at the same time. And I don't think that that approach even makes a lot of sense for anyone involved. So I don't think that's going to happen. But what you would probably see is not necessarily that cryptocurrencies would go to zero, but you would see a huge amount of them completely dissolving, and you would see exchanges dissolving. You would see a lot of things changing very, very quickly. So this is a really good question, and we can only speculate as to what would happen if this were to happen. But think about it. There are tens of thousands of cryptocurrencies, and if all of them were to be qualified as securities, or the majority of them, enforcement action would take decades to follow suit against all of those crypto projects. So it's one of those things where it would take a long time to sort out. I don't think it would be everything's a security, everything falls apart in one day. It would take a lot of time. So thank you for your question. The next question, your thoughts on Celsius and Alex Mashinsky. Okay, so here's the deal. Celsius was a project from the perspective of their main platform, their yield earning and custody and all that stuff that I was fond of. I had some resources in there, so I lost money along the way here. I'm expecting to get none of it back because you take that risk. When you give up access to your cryptocurrency and you let somebody take it in custody, which you have to do to use their earn products where they were giving you yield on your cryptocurrency. Anytime you give up access to your cryptocurrency, not your keys, not your crypto, you're risking loss. And so I knew that going in, and I got burned, right? And as did everybody else. But a lot of people didn't realize the risk they were taking. And that's the big issue. So here's the thing. Alex Mashinsky talks a really big game. Always has, probably always will. There's already talks about Celsius recovery plan and issuing a new cryptocurrency, which I think is the dumbest possible idea that you could ever think of. That I would stay as far away as you can from any plan like that. Don't buy into any of the additional cryptocurrency debt issuance stuff that's being discussed. Okay, it's crazy. The reality is that this whole talk about banks are not your friend, which was the tagline for Celsius, sure, that might be true, but clearly Celsius is not your friend either. Clearly Alex Mashinsky is not your friend either, because people who are in a place where they've lost money in Celsius because Celsius went belly up and they misappropriated funds or they did XYZ according to reports. Okay, a lot of this stuff is going to have to come out and be fact checked and to be reported in court proceedings, right? I'm just speculating based on what you see online. Let's say all that's true. They did X, Y, and Z bad thing with money and they went completely belly up and they've lost you money. Here we sit now and we think about the fact that this could have been avoided. It could have been something that were communicated more transparently to people. Hey, we made a mistake. Or it could have been planned for way earlier. And the reality is that just didn't happen. And there's a reason why all of these major crypto lenders and sort of the crypto bank style organizations, centralized/decentralized finance, like halfway companies, Voyagers of the world, Celsius of the world, they all went under at the same time because they were over leveraged. They made a lot of mistakes along the way and they lost a lot of people money along the way. My thoughts about Celsius and Mashinsky is it's a huge lesson learned, but for someone who didn't take risk management as seriously or didn't know the risks, even worse, who didn't know what they were getting themselves into and that there was a risk of loss, and there's plenty of people like that. For those people, it doesn't matter what lesson we've learned because that could be their life savings that they lost. So to me, I think about it in those terms is that, yeah, it sucks for me to lose money. It sucks for, friends of mine to lose money, but it's a whole different story if you lose everything and you didn't know the risks. I knew the risks. A lot of you might have known the risks. I've shared that with you, but not everyone did. So my thought is that this is a valuable lesson for the whole industry. This is going to draw more regulatory scrutiny as it already has. And the reality is it's very likely that people do not get their money back. And that is a tough pill to swallow for somebody. That will likely send certain people out of the crypto space for good. And that's something that we have to accept as a community, that we are not perfect. Things have been done very badly in this space. Terra Luna, UST, Celsius, Voyager, Three Arrows Capital, you name it, everything has come apart in 2022. And it needs to be an opportunity to rebuild. And I hope that there's some opportunity for people, especially those that were in custody, especially those who were in earn, to get at least some of their money back. And the truth of the matter is it's hard to see how that's going to happen, but it's possible. And I really hope that they do. And to me, I would not trust anything that Celsius, Alex Mashinsky touch from here on out. I don't care how much you liked it. Do not trust. You break somebody's trust, it's really hard to earn back. They need to earn it. Don't just give it to them for free. That's my philosophy. Sorry, it's negative, but it's just the truth. Next question is from Zulu Echo 23. Do you think there's still any real incentive for people to pick up cheap GPU miners to mine Ethereum Classic or other coins, or is proof of work phasing out slowly but surely? So here's my philosophy. So in the wake of the Ethereum merge, we moved from proof of work to proof of stake on Ethereum. And now we have a lot of displaced GPUs, or graphic processing units. So GPU cards that you use for gaming that people would use to mine Ether on Ethereum. So you've had a lot of people move to Ethereum Classic. You've had a lot of those miners move to Ergo. You've had a lot of miners move to Nervos. Lots of different networks out there that still use proof of work, but dwindling pretty quick. Here's the thing. If you already have GPUs and you want to mine and you are mining, feel free to keep doing it. Ethereum Classic, Ergo, some of these other chains, they are still efficient. You can still mine on them. You can still make some profit. But if you're thinking about going and buying GPUs, I would not do it. And there's a reason. A lot of these miners are realizing that proof of work is likely going to continue to get phased out more and more and more and more. And some networks might still support it, but is there going to be enough market for you to make a lot of money? Probably not. And the prices of GPUs have been so inflated because of mining for so long that you're likely going to get fleeced when you try and buy them. So don't be exit liquidity for miners that just want to sell it to you and say, hey, go mine Ethereum Classic. You're going to make a ton of money, because you probably aren't going to make a ton of money. And the reality is buying them could end up being a huge risk. So I would not try and build a mining farm with GPUs right now. That's just me. I'm no mining expert, but that's my philosophy. What I would say though is if you have some GPUs on hand, you want to test the waters, you want to test it out, maybe you get a really good price, sure, you could try it. But I really wouldn't say there's enough incentive for you to go out and buy GPUs to start mining any different network right now. Probably just not worth your time, not worth your money. Now, today's crypto Q&A is brought to you by Metaverser, a free-to-play virtual world that allows players to explore the metaverse and play to-earn games for a chance to earn cryptocurrency inside the virtual world. Gamers can travel throughout the virtual world using ports, train stations, and airports, complete missions, and play their games of choice in this virtual environment. For those interested, the Metaverser token sale is also going live on Monday, September 26th. Of course, remember, this is not a call to action to buy or trade cryptocurrency assets of any kind. Please adhere to strict risk management practices. I will leave links in the description below of the video and the podcast if you're interested in learning more about Metaverser. Now, if we move back to questions here, we've got another question from Steve D. Simpkins. Apple recently allowed developers to sell NFTs in-app. However, it will take 30% cuts. How long do you think that's going to last? What's the future of mobile-first Web3 experiences? So I didn't even know about this news that Apple was allowing developers to sell NFTs in-app, and I'm not even sure how they're enforcing 30% cuts, frankly, because if you introduce a web view and you're allowing folks to buy NFTs with their native wallet, I'm not really sure how they can enforce that. I suppose they have control of the entire user experience and all of the app processes. So they could probably tell if you're moving to a wallet application or you're signing a transaction. So maybe that's how they do it. I think it's a little creepy personally. So here's the thing. Apple has been really clear that its business model is taking cuts from developers on apps and on experiences and in-app purchases and all that stuff. And if they're qualifying NFTs as in-app purchases, I guess we could call that progress because they're not saying NFTs are not allowed. The thing is that if they're going to take that cut, they need to do more work to support cryptocurrency applications and to allow people to build what they want to do. dApp browsers, wallets that can use the secure enclave on the device. If Apple's going to take this type of cut from NFT sales or crypto sales or whatever sales they want, then they need to do more to support the crypto space from the hardware perspective, from the software perspective. At least Samsung has its own crypto wallet on board, which I would say means I would feel a little better about giving them a cut, but 30% is a little bit ridiculous if you ask me. I would love if someone could provide me a source to where we found this information about Apple taking that cut. The reality is, though, most mobile phone companies are in the business of taking a cut out of anything that you do on their platform, Apple especially. So it doesn't surprise me, but the future of mobile-first Web3 experiences is probably in either open source phones or it's going to be in this area. I'm sure you're going to have a little bit of both. You're going to have people who are like the Linux users of the world who use their own phone and their own phone OS and they're accessing Web3 apps directly. And then people who use the trusted interfaces, the apps, the easy to use stuff through Apple and Samsung. And they're going to have to pay a little bit extra for that convenience. So you'll have the super user and the average user. In the future, though, no one's going to care about Web3 and NFTs and crypto. It's all going to be abstracted behind a user interface. So the reality is Apple and Samsung and all these organizations that build mobile phones, they're going to be probably the interface to a lot of this stuff. And the average user is not going to want to deal with a lot of the, more tactile, strategic ways that somebody goes about setting up a wallet on their computer, going to the IPFS address to find the user interface for Uniswap. They want an easy to use app. So that's likely the future, but it's optional, I'm sure. If there are going to be ways for you to access things. Diversity of client is one of the fundamental properties of Web3, is that if you're using smart contract-based applications, you can build your own interface, you can use someone else's, you can do whatever you want. You're interacting with smart contracts that are public, so it's up to you how you use them. So that should make you feel a little better. And then here's another question from I Speak Nerd on Twitter. What will the fallout of CFTC's fine against DAOs as unincorporated associations be? Now, I can only assume that this is related to the B0X, I believe, the B0X case. Basically, here's the thing. I don't think that the CFTC is yet taking distinct action against DAOs in general, more so DAOs that are conducting regulated business activities. So if you're allowing for trading or you're creating a security, right, then the SEC starts getting involved. If you're doing these controlled business activities or regulated business activities, then you're in a little bit of a gray area. But I mean, I look at something like Shapeshift, for example. They're a DAO. They used to be a regulated entity. I'm curious to see what Shapeshift would say about this and whether or not they fear the regulatory perspective of the CFTC and others around what constitutes a DAO. The thing is that most DAOs are operated in a very centralized way still, because we haven't quite figured out how to implement a DAO in the correct way. We haven't figured out how to implement a DAO in a truly decentralized and autonomous way. You still have a few really powerful entities in the middle of things, and you still have a community of token holders that can control things. You still have people to go to. So DAOs are not a perfect construct. DAOs are also not perfectly decentralized just because they're called a DAO and because you have a token and because you vote on stuff. Corporations vote. The board votes. Shareholders vote. That doesn't make it decentralized. So proxy voting, otherwise, every corporation would be decentralized because, I proxy vote for shares I hold. The reality is that when it comes to DAOs, you're going to have this growing pain like we've had for cryptocurrency, like we've had for NFTs, and like we continue to have for these, where people figure out how to do them better, how to do them properly, how it fits into regulatory frameworks, and how it doesn't fit into regulatory frameworks. Regulators are going to respond, people are going to get mad, and then we're going to hopefully compromise and find the right balance between what makes sense to protect people from really eventually fraud is the end of the line. And I think that DAOs are probably one of the more promising constructs in the Web3 space or the crypto space, but only if they're implemented in a way that's actually decentralized. It actually presents some sort of value to the people, to the people who participate in the decentralized community. If it's just called a DAO, but it's really just an LLC at the end of the day, there's no real value in that. And those are the ones who are going to get targeted for regulation. If it's still centralized, if still stuff's going on behind the scenes from the select group of people, then you're probably going to have regulatory scrutiny. So I don't think it's a huge deal yet, but at the end of the day, we're going to have to see how this thing pans out. And I'd love to get some sources from you if I'm not talking about the correct CFTC case against B0, which I think was related to like margin trading and leverage type of operations. All right, and that's going to do it for the crypto questions today. I want to thank you so much for leaving your questions. If you have your own question and you want to get it answered next week, please leave it in the comments on YouTube or tweet me at Hashoshi4. If you're on the podcasts, hope you have a great rest of your week. And the next weekend, I'll see you again for Crypto Over Coffee. Thank you so much. And until next time, cheers.